What? I'd have to text it to you. Hello, good morning. Okay. Hello, good morning. Thank you so much for joining us today. The weather is just terrible today, so we only have just a couple folks here, but that's okay. So today we're going to go through a workshop about life insurance. This workshop is presented by the King Solomon Cares Board and the Village Zone Faith Leaders. Your presenters today are myself, my name is Carrie Michael, and Elliot Harris. Let me provide some background as to how this workshop came to light. So I am a member of King Solomon Missionary Baptist Church. I've been going to King Solomon for a long time. Hate to date myself, but it's probably about 18 years that I've been at the same church. So a couple months ago, Pastor Wagstaff called me and we talked about life insurance and the importance of life insurance in the Black community. One of the reasons for this phone call is because Pastor Wagstaff commented about the fact that we as a church had experienced some very unexpected deaths, and he was continuously getting phone calls from people in the church, of course, grieving parents, grandmothers, mothers, wanting to know if we had a benevolent fund. King Solomon does not have a benevolent fund. Most churches probably don't. We too were hit with COVID and being forced to go online, the building shut down, things of this nature, and we just don't have that type of funding. So we continue to have a conversation about insurance, what that means to the Black community, life insurance, and how important it is. And so we got this workshop together. Elliot and I are both employed at Physicians Mutual. So I am a senior product owner. I work for the Enterprise Technology Group that is in the Information Technology Department. And Elliot is one of our top selling agents. He's always getting numerous awards. He's one of our top performers. And he is also here to work with me today and to discuss the life insurance process, the application process, and things of that nature with you guys. We are also both members of the Black Employee Resource Group at Physicians Mutual. And just a quick disclaimer, we're not here today to sell anybody any life insurance. This is a informational workshop. What we're doing today is trying to reach out to the community, give people the resources, the knowledge that they need in order to make a good purchase, because everyone has to have life insurance. Whether you plan to die or your death is, because of old age or unexpected, and something sad may happen, you just have to have some coverage. This is one of the things you just have to have. Elliot is a licensed insurance agent, though, so he will give out his contact information. And if you're interested in any type of further information or want to talk about life insurance, he is always available at the office. So with that being said, let's go ahead and get started. I would like to open up with a prayer from one of my favorite books, and that is Psalms chapter 84, verse 11. For the Lord is our sun and our shield. He gives us graces and glory. The Lord will withhold no good thing from those who do what is right. I'd like to go ahead and discuss the historical significance of life insurance in the African American community. So this actually is a picture of my grandmother, and her name is Annette Michael. And so, again, we're just going to, kind of go way back into the, 1950s, 1960s. But as a young child, I clearly remember my grandmother, Annette Michael, answering the door for a short white man who came to her North Omaha home at the same time every few weeks to collect her $5 life insurance premium. I remember sitting in the living room wondering what exactly was going on. Why were we giving this man $5 every few weeks? And what were we going to do when she did pass away? This was sometimes an uncomfortable situation, as well in the household, because sometimes we had the $5, sometimes we didn't. But sometimes the gentleman would come and he would sit down and she would offer him a cup of coffee. This transaction usually took no longer than 10 minutes, and it was always a cash transaction. It seemed like Grandma was always giving the insurance agent just the little bit of change that she had left. He would take out his notebook, he would write down a few words, and then he would be on his way. That routine was the same routine for 35 years. And then when she passed, we literally had just enough money to bury her. Page me down. So what is life insurance? What exactly does that mean? Insurance is a very simple concept. It is a contract between a person, an entity, or a group and an insurance company. It allows the insured to pay a premium that helps protect them in case of specific financial loss, or in short, paying a company to assume some sort of risk. A common example of this is car insurance. Most state laws require drivers to be insured. The driver or the insured is paying an insurance company to take on some of the financial risk involved with having a car accident. Life insurance is just another example of that. The insured is paying an insurance company to assume some of the risk or cost that comes with death. Who needs life insurance? That's a quick answer. Everyone does. Everyone needs life insurance because we are all going to die. Sometimes it's an unexpected death and sometimes it's unexpected. Please understand that family matters and conversations can be sensitive, so don't delay the conversation. Be prepared to talk to your family members about exactly what you would like at your service, at your burial. Would you like to be buried or would you like to be cremated? When your estate is planned, it just makes it easier for the entire family. You have to have those conversations. Life insurance also offers protection for your family. I think this is a good question. Again, this kind of goes back to the rub, you know what I mean, that we kind of talked about as far as what why are Black folks typically less insured than other races? And so just a couple stats on this slide. African Americans are insured at a rate of 56%, but with lower value policies. White families are typically insured at a rate of 52%, but with higher value policies. And Elliot helped me out here, but that difference is the monthly payment. It's the premium in there, because typically our budget is just a little bit tighter than theirs. So when we have just an additional $46, maybe $56 that we can spend on life insurance, their premium may be a little more up there, maybe 120 is what they're spending. And we're here today to talk about decreasing that gap and making sure that everybody is insured on the same level. We can do it too. If we've got $40, we got $70. If we've got 70, we can pinch a little and we can get to $100. Excuse me, sorry. Okay. It's technology, phones. Okay, and so here are some common insurance terms, and I wanted to talk about just, common language as far as insurance, because we at King Solomon have been talking about this for probably about a month or so, and I just wanted to just get down to the granular level and just kind of tell you a little bit about insurance. So again, like we discussed earlier, life insurance is a contract between a person and an insurance company. The primary insured is the person for whom the life insurance policy is issued. So that is typically always your primary owner. You always, for a life insurance policy, have a beneficiary. A beneficiary is the recipient of a life insurance policy death benefit. That's the money. That is the actual cash value that you cash out when that person, that spouse, that aunt, that child dies. That's that beneficiary, and that is always determined by your policy holder. Please know that you can always change your beneficiary at any time too, and you can divide it up. You can leave it to, let's just say you have 3 kids, you could leave everybody, 35% apiece. Sorry if that math is wrong, but you got 2 kids leaving 50% apiece, and you can also put stipulations on that money, exactly what you want done with it after the cost of the burial. A claim. This is, again, common terminology that we just kind of use at work. But insurance, again, it's a simple concept. You've got money coming in and money coming out. So you have a premium, and then you've got a claim. So the claim is the necessary paperwork to receive the life insurance payout. This typically requires a death certificate for the deceased and proof of identity for the beneficiary. So when you die, the state of Nebraska gives you a death certificate. That is all you need in order to cash in your policy and your claim. As long as you've got a valid and current policy and a death claim, it's almost illegal to refuse that cashing out. And that's what we do. Elliot and I see it every day. Unfortunately, we get those calls. Elliot, as being a licensed agent, he sometimes receives the calls, those crying phone calls when a loved one has died and someone is asking for the email address or the mailing address or to speak to someone promptly about their life insurance policy. We wire money to funeral homes all the time. We do whatever the policy holder would like done. And that's another one of those important things that we want to have you always discuss with your family. What do you want done? Do you want a portion of the money to go to the funeral home and then the rest to the kids? Would you like to pay off some bills after that, the money's been cashed out? Or what exactly is your plan? We talked about premium, and premium is the payment that you need in order to keep your policy in active and up to date. So again, that is that monthly payment that the insurance company needs to have every month on the books just to make sure that you are covered, so that when something happens, you can have a proper burial. I am going to let Elliot come up and talk to you a little bit more about life insurance.
Excuse me as I adjust this here. I'll be running the slideshow, and I'll be flipping and toggling back and forth. So please excuse a quick delay in that conversation, but I appreciate you, Carrie. Great introduction, great production as far as what life insurance entails, and I love it all. You did a lot of heavy lifting too, so I don't want to talk too much about all of that. What I will be getting into today, ladies and gentlemen, again, thanks for coming out. I know it's cold outside. This is Nebraska. We get everybody's weather, so you know how it is. But at this time frame, I'll be talking about life insurance along with, the product aspect of things. So I do note she did skip over guaranteed issue, so we'll talk about that, and we'll talk about the other styles of life insurance as well, as far as term insurance, whole life, and then obviously guaranteed issue, which is like your final expense or your burial type policy as well. It depends on where you're at in your life and what you have going on asset-wise as far as your finances and what your needs are. That kind of really mitigates what you'll need to get or what you'll need to have as far as life insurance is concerned. So we'll kind of start with this information. I have to look at two screens, excuse me here. All right. So looking at this information here, what can life insurance do for you? Right here, we have the average funeral costs in Nebraska is around, $8,500. I take it up a little bit higher. I say around $10,000, $15,000 if you want to have a nice funeral. I mean, $8,500 will get you to the actual, mortuary or get you outside the ground, but you got to get put in that ground as well. And also services that go beyond that. So $10,000 to $15,000 has kind of been raised up here, especially after the pandemic. You'll be seeing those costs go up. For a really great funeral, $20,000. I don't know what you can do with the extra, in that scenario, but those have gone up a lot as far as the average for funeral costs. And when you look at cremation, that's about right as far as that figure is concerned there. When you see 7,560, that's pretty much the rate for an actual cremation. You could see a little bit lower in that scenario, around 5,000, but that is a going rate for cremation. So you want to know what your needs are going to be. All right, so are all life insurance policies the same? This is where we're going to talk about the term insurance. This is where we're going to talk about the whole life insurance and the guaranteed issue aspect as well. And I'll go through some application processes, that will show you what those applications look like for your term, your whole life, and your also guaranteed issue. Some are easier than the others, and some are better than the others to get into as far as application-wise. Others, when you get denied for the application, it kind of denies you around the whole board when it comes to try to apply for other insurance with other companies. So we'll kind of talk about the stipulations with that and what might be a good fit for you out there as well. So the difference between life insurance here, we have the permanent whole life insurance. We have the term life insurance. And that last one right there, it's a little typo. It should say modified life insurance or final expense. So thinking about that permanent and thinking about that term, all products are the same. I'll be quite honest with that. All products are the same. They might have a different name, different title to them when you go to different companies, but they all work off the same type of chassis. Okay, you have your whole life and you have your term policies. Your whole life and your term policies. So what you want to do when you think about these type of products and what you're thinking about your needs is, where do you currently sit with your situation, and what does your family need if you're no longer here? Okay, so when you think about term insurance, that word term should ring high in your head. Term. It's only going to last for a certain amount of time frame. It's not going to be for your whole life. I like to think of it like renting. When you rent a apartment, when you have an apartment, you're renting that. You don't own that apartment. It's going to be time to get out of that apartment sometime. You have a lease that's up in a year, 2 years, 3 years, however long you get that lease for, but you're done. You take your furniture, you take whatever you brought in that apartment with you, and you leave. Okay. There's no value add in that term. It's only good for while you're there, and you're only paying on it for while you're in that actual policy or while you're there. A lot of people think that term's a great source because it's cheap. It's very low premiums for you on a monthly basis. You can get a lot for yourself when you have a term insurance. You can get a lot of cash value if you were to pass away for a term insurance, but there's no cash value while you're still living. So it's just going to be for that instance that you pass away. So what that means again is that you're paying for a certain period of time. And I'll show you an example here in a bit. It can be a 10-year, 20-year term is what we carry with our company, and we have some other terms as well. But once those years are up, your term is done. You can do two things. You can cancel out that plan and get another plan at your current age. And again, we'll talk about your age as well. Or you can keep that policy and it will gradually increase every year. So now you're paying more than the policy was worth 10 to 20 years, into the future. So you kind of want to watch out for term insurance. I'll speak about this ahead of time. Term insurance, I like that for my youthful individuals, people who are in college, people who just got a job, just had kids, get into that lifestyle where they have a mortgage. Because why? You're going to start growing up and some of those things will start going away for you. So when you look at term insurance at that time frame, you want to look at what your debt ratio is, because those debts won't be there forever and term insurance won't be there forever. So if you happen to pass away, you're a young individual and you pass away early in life and you have a mortgage to pay and you have family members, you can have a term policy, because that's definitely going to pay out at that time frame to your family if that was to occur, and you paid a cheap or a low premium for that expense. So I really, I personally like to see term insurance with my more youthful individuals from 20 to probably say 40 years old in that scenario, because again, it's very low price for your premium monthly, and you can have a big high face amount, which will be the amount that pays out to your beneficiary if you pass away, versus the whole life insurance. Now stay with me on this. We're going to go through the whole life conversation piece, and that's going to be a little bit more intriguing, because that's going to be where your value add is for you. All of us like to think about ownership. Nobody wants to just rent out something for themselves. So as we talked about term insurance being for somebody who is just, renting, ownership is going to be in that whole life policy. Just like that namesake, whole life will be with you for your whole life. So you're owning that. When you own something, what does it do? It gets value to it, right? And that value is something that you can play upon as you're still living. You can borrow against that policy. Duly note, when you borrow on a policy, what you're doing, you're borrowed against yourself. So it will be a loan, but you can take money out as you're still living. And if you can want to buy a house, buy a car, go on a vacation with that, you can do that as you build money with a whole life. So it can be sort of something where you can build money and invest, but that word is very taboo. You don't want to invest in life insurance. You just want to use it for the death benefit. But if something happens later on in life, whole life does have that value add where you can borrow upon it before you pass away, or you don't have to wait till you pass away, borrowing as you're still living. Whole life is going to have that point where you are actually able to keep that till age 100. We have some plans to go to age 120. And now, hopefully, God willing, we live that long. I want to see 120 and be nice and healthy. But that point being is that you have that security. It's not going to go away for you like term plans do. The whole life plan is going to have a more advantageous premium. So it's going to be a lot higher premium than what your term plan is going to be. But again, you are keeping that value add for yourself. So it's not just going back to the business. It's going to you, into your plan. It's also going to go to your family, again, God forbid, if you pass away. So we're going to go ahead and expound on that in a little bit. And then the modified whole life, that's not going to be a term, that's going to be whole life we want to put there. But that modified whole life is what we're saying instead of the term. That is going to be a final expense policy, guaranteed issue. Modified life is what we call it with our company. So what that's going to be is going to be a burial policy specifically for just if you for your final expenses. So we have folks that come into our company and they need insurance. They maybe had insurance, maybe somebody passed away, or what's another good example? So they had insurance, somebody passed away in the previous time frame, and it made them spark their mind like, hey, you know what? This happened to, Susie Q or John Doe over here, and I think I need to go ahead and insure myself because I've seen what their family had to go through, and we need some insurance now. Okay, so you're later on, you're mature in life, insurance is gonna be a lot more expensive because it's based off your age and your sex. So male, female, and obviously age. The younger you are, and we'll show that later on as well, the younger you are, the more cheaper it is to get life insurance for yourself. The more mature you are in age, it gets more expensive. So the final expense makes it easier for you to apply for insurance without any underwriting. And the underwriting can play a big deal when it comes to your whole life plan and also your term plan. Underwriting is going to be where they actually look at your health. Some of them look at your financial background and see, why do you need this money? Are you healthy enough to be insured? So that's kind of where the original whole life falls into play. Whereas the final expense, the modified whole life, which again, that's term, but it's modified whole life, they don't ask you those health questions. You're able to be guaranteed the actual product without any type of health questions or financial background search. So we'll talk about that here in a second as well. I just spoke about this here earlier, getting life insurance, young versus older. On the left-hand side, or right-hand, depending which way you're looking at that. On the left-hand side, you have the young man, you pay less premium when you're younger. We just talked about that. You save money. Hopefully you're saving money at the same time frame. And then you are in excellent health, which makes your premium cheaper. So again, health plays a big, big role on how the insurance company dictates what face amount you get and what your premium is going to be as well. So again, your health plays a big role in that, along with your sex, again, male or female. And then not many responsibilities to actually have. So you don't have that many responsibilities income-wise when you're youthful, so you can afford a little bit more. I mean, I know we got our cell phones, we got all the streaming services, et cetera, that you look at today, your coffee, et cetera. But if you shave some of that down and apply it to, in your youthful age, a term policy, as I mentioned earlier, or even put it towards a whole life where it's a lot less, that's going to pay dividends towards, your future. Again, we all heard about, compound interest, saving a penny, each day, or, from your youthful days all the way up to your mature days. What does that equate to? A lot more than what the average cost would be if you just hold on to that. So that's how you have to think about life insurance in that scenario. It's just one of those key pieces in the puzzle to your financial growth. So again, that's what happens when you get into a plan when you're much younger in life. Now, moving on to that mature side, when you're mature, I don't like to say old neither, by the way. You hear me say mature a lot. I'm maturing a lot. I ain't gonna get old. Y'all ain't old. You're maturing in life. So and when you get to that mature part of your life, you pay a higher premium. Okay, let's talk about that. You spend more money. You might have kids, grandkids. You might have college, etc. In there, and everything else. Maybe you want to get a new car. Maybe you get a new house on top of what you've had prior. You become uninsurable due to health issues. So that's another part we just talked about earlier. When you're youthful, you don't have as many problems. You're healthy, right? We would like to think we are. But then when you get mature, you go to the doctor a lot more. You have a lot more things that break you down. Once you, I'll walk it back. I like to think about the Carfax. If you ever had a car and it's been in an accident, you try to resell that car, that Carfax is going to tell all that history about what happened. So that car is not going to be as top notch as it was 10, 20 years ago when you had that car once it's been in an accident. So now it depreciates in value, and also the wear and tear could be even more. Think about that with your body. Think about that on how life insurance looks at you as far as the application and as far as underwriting. So when you're mature and you break down like that in life, you have these small little hiccups and you think nothing of it, they see that on your report. And we'll talk about the MIB report as well. That's something that life insurance companies use, sort of like a credit report for your health, to see what your medical history has been in the past, to see if you actually warrant this actual benefit amount at this certain price. So we'll talk about that here in a moment as well. Family and other responsibilities to cater. We just talked about that. So, when you're mature, you have, your grandkids, your kids to kind of take care of as well. And other things to think about. So your finances might be going left and right, helping other people out versus yourself. When you were younger, you didn't really have those opportunities. So you actually could put more money away, but you never maybe thought about that. So you have to kind of think about those things when you're mature, because things happen, so that's where that final expense comes into play. We'll talk about that. So once your family members, let's see here. All right, here we go. So once you or your family members are covered, so I'm gonna pause right here, and we're gonna go to an actual application. So I'm gonna come out of this screen here. Bear with me one moment. So what I'm gonna do right now, folks, is I'm gonna go ahead and bring up some information that I was just speaking about, so you can actually see information on the life insurance application side of things. Now, I'll go ahead and put a disclaimer. It's not going to be too visible from up front here, so if you can't see it, don't worry. I will be getting this out to you guys in a PDF format after our meeting today. But am I good right here? Yeah, I'm going to bring it up here. Yeah. So. Coming up? It's going to be slow, though. Oh, I'm sorry. Gotcha. Right here? Yep. Cool. All right, there we go. Thank you very much. All right, so there we go. All right, so this up here, guys, again, I know if it's hard to see because of the light and it's kind of far away for you guys, but I will give you some PDF files on this later on. So this is going to be our term information. Thank you. This will be our term information. We have 10 and 20-year terms. So I talked about the application for that, or I'm talking about it right now, excuse me. And it's going to be your criteria for signing up for a term policy with our company and with a lot of other companies out there as well. But I'm using ours as a general template as we are talking today. So, issue ages for this term plan, again, it's going to be a 10 and 20-year term. Remember when we talked about term earlier? It is just a temporary insurance plan for you. It is not permanent. You get into a term policy, you have 10 years or 20 years with this term. All right, you live past that time frame, the policy does two things. Either it can lapse out for you or you can cancel the policy out. And actually, that's two things right there. The third thing being that you can continue the policy and it continues for you. Each year, it increases in the premium. So those premiums go up each year. So if you have a $50,000 term policy, for 10 years, and you live past that 10 years, because you will, but you just got just in case something happens, but you live past that 10 years, each year that term policy increases and doubles or triples in its premium that you were paying steady premiums for that first 10-year period. That will actually increase for you each year. So that's if you keep the term policy past its term period. And that goes for 10-year or 20-year in that example. As you see here, you have the eligibility, you're eligible for the actual term policy at age 18 between 70 for 10 years and for 20 years, 18 to 60, okay? And the reason why it gives you a longer period of time between 10 years and 20 years, so it shortens it up. It says you can only get into this plan between 18 and 60. So you're only eligible to enroll at that time frame is because they don't want you to go past that point. They don't want you to be at 60, 65, 70, getting into a term plan. All right, it's going to cost that insurance company money if you happen to pass away. Now, the percentage of how many term plans, the percentage of actually, take some water real quick, sorry. All right, so the percentage of how many term plans actually pay out is 2%. That's the overall average of how many term policies actually pay out for anybody who's insured underneath those plans. And so the insurance companies know your life expectancy. They have people up there, similar to Carrie, crunching numbers who know your life expectancy. Black, white, Asian, Hispanic, male, female, they know your life expectancy. That's their job. And so when you purchase these plans, they already know pretty much that you're already on the wheel. The mortality wheel is what that is, the mortality wheel. And they know that plan pretty much has a very slim chance of paying out. So they're going to take that bet on you. And with that, they give you a lower premium price, again, depending on your age, and they let you get a higher actual face amount. Now with our company, what we sell over the phone, we do up to $50,000 for our term insurance plans over the phone. We can do more, but that has to be in-person agent that sells that to you for $100,000 face amounts and above. But for just over the phone transactions, we do $50,000, and we can go as low as $10,000 as well, and do increments of 20, 30, and 40. So again, you're just renting this. You don't own this. You don't own this at all. It's only going to stay around for a certain length of time. You can renew this plan after its time frame, but again, it's going to double. And then also, if you want to convert this plan, you do have an option to change it from just a temporary plan to a permanent plan, but you want to do it in the most earliest stages because, again, the premium is going to be based off your age, okay? And they don't really tell you that when you speak to an agent or any representative. They don't really tell you about the conversion aspect of things. You do have the option to get out of the plan and get into a more permanent plan as you become more endowed in your financial situation. You have more assets. You maybe want to lower that down and keep it for your whole life. You can convert that over to a permanent plan, but make sure you're aware of that. They normally give you a 7-year grace period to do so before the plan actually terminates. So look at that information depending on which company you go with. So then scrolling down on this information is pretty simple to see. Let me see, go back here. All right, so with that information there, term plans, you just rent. So you're not owning the term plan, you're just renting that term plan out. And when you segue yourself over to the whole life plan, this is where it gets really meaty and it gets back into that conversation piece of purchasing something for your whole life. So again, with our company, we have the 10,000 up to 50,000 that we do over the phone for these whole life plans. This is going to be something that's going to be permanent for you. There's a little bit more information on this plan versus the other plan that we saw earlier for the term. And again, I'll give this information to you guys as well, so don't try to squint to see it. But what you're looking at with this term plan, or excuse me, with this whole life plan, again, this is whole life, is that the full face amount for the death due to accident or sickness is payable from first day of coverage. Any type of suicide is going to be a 2-year contingency period. So suicide is a 2-year contingency period. But any type of accidental death or sickness is going to be first state coverage. Now, it's going to be important to know about this whole life plan because you have to go through the underwriting. We talked about that earlier. So the underwriting is going to scrutinize your health. And I'm going to go ahead and jump forward and talk about that right now. So when you go through underwriting, this is something that we see first and foremost when we're talking to you on the phone or if you're speaking to us in person. This is the good stuff right here because a lot of people want to get happy about getting insurance and they want to apply for that. And, you want to be the awesome agent representative that you are and say, yeah, I got you. Don't worry. We can do this. But then, and you ask them if they're healthy and we all say what? Yes, we're all healthy. Yes, I'm healthy. I got this one thing that happened back then, but don't worry. It's good now. We're good. So these are those little things that stifle you in the conversation when you say this. I have to say this verbatim. Before we get started, there are some things that could disqualify someone from coverage, such as height and weight, AIDS, HIV, disability due to illness. Also, you must be a U.S. citizen or granted a permanent visa. That last part, mostly everybody's a U.S. citizen I speak to, or some people do have visas, so I don't have to worry about that. But that first part, going back up to that first bullet point, height and weight. How many of us think that, our height and weight is just fine for us? We're fine. I've been this height and weight for 10, 15 years. I'm good. I'm healthy. AIDS, HIV, this is something that used to be taboo back in the 80s. We all know about that. But now what do we see on TV every day? There's drugs that cure this like nothing, and they're just advertising that whole situation. So that's still an issue. But yet they're clearing that up as far as the medical system is going, but it's still something that we waiver left or right. So that can be something that could disqualify you. And along with disability due to illness, and that's a big one. Disability due to illness. And again, I'm sorry it's in red, you can't see it, but I will give you the PDFs on that. So disability due to illness, what that means is it's a blanket of things. We talked about your health. Now that thing that happened 10 years ago that you thought was nothing, that's something that can come up in that MIB report. Now the MIB is a regulatory nonprofit agency that's pretty much like the credit bureau for your health. Credit bureau for your health is what the MIB is. So they see everything that you've done, everything that you've had done through the medical system. And that's where the insurance companies come into play, and they have this little, I like to call it clique or group, that they can see everything that you've done. So if I go to, Physicians Mutual, and I apply for a plan, and I get turned down for some reason or the other, I'm thinking like, okay, well, that's fine. Turn me down, I'm gonna go to the next place. The next place sees what you got turned down for at Physicians Mutual. Same thing with the next place you try to go to as well. So it's just advocating that we have a good pool of applicants that are healthy, because again, the top of the mind of the business is not a business if they're losing money, they're business if they're making money. So your premiums is money that they're making. If they pay out these claims to your family members, they're losing money. So they want to make sure you're as healthy as possible. That's what that red letter language is about. Yes, ma'am. Go ahead, grab that mic real quick. I'll turn it on for you.
Do they tell you what your health problem is, why they deny you?
Good question. I like that. So there's HIPAA rules that fall into play for that. And again, if you guys have questions, I'm open book. There's the mics in front of you. Go ahead and click on that, and you can speak so everybody can hear you out there in the streaming world. But she said, do they tell you what the health problems are as far as why they're denying you? So yes and no. So if you're denied, you'll get an actual letter from the actual company telling you that you were denied for such coverage. And for further information, please see your doctor for whatever reason that is. Now they'll put a code in there. They'll actually code the letter that they send out, telling it's like a code telling the doctor why you were denied. So the company can't speak to you directly about that. So they want you to go see your physician. That way, if you want to deny the claim or dispute the claim, you can go to your doctor and they can write you a letter and they can go back and forth between the insurance company. That's a long story of how that works, but they tell you it's in code. They send it to your doctor, do the HIPAA reasons so they can't tell you in person. And then your doctor to say, oh, well, you're denied because of this. I'll just throw something out I saw recently. You're denied because of your thyroid issue that happened back here. Where, well, that shouldn't be an issue why you get denied. Let me go ahead and write a letter for you to the company, reassuring them that this is not an issue and that you've had 5-10 years of, good health. So that's how that works. So they will tell you, but unfortunately, they won't tell you directly. So you can't call us up and ask. You have to go to your doctor. Okay, good question. Thank you. So yeah, that's a lot of work to do on top of that, Ma'am, go ahead. Yeah, go ahead and put that mic up one more time so they bring you.
Is there a insurance company for high risk people?
There is. Yes, there is. And so for you guys who just came in here, Carrie kind of notated, again, if you didn't catch my name, I'm Elliot Harris. And I love these questions you're saying already up front. We're not here to sell you anything, but I'm here to give you the message and help you learn. So I'm going to shout some other companies' names besides Physicians Mutual that they're out there for you when it comes to high risk. And so that's going to fall into that guaranteed issue aspect of things, or final expense is what you're going to be looking at. Okay. AIG is a big one out there. That's AIG. They're a big company out there that does that for you for the high risk aspect of things. There's another company called excuse me if I'm saying the acronym wrong, but it's NGL, excuse me. And I'll actually qualify that here in a little bit, but NGL as well. So these are two companies, acronym companies, AIG, which is which is similar to American General, but it's not the American General you see on TV, to be quite honest. So that's what the AIG is for. That will deal with high risk. I've seen them deal with AIDS, HIV. I've seen them deal with stroke, cancer, heart attacks, and they just overlook that. Now, when you're looking at companies like that, be aware that there's going to be a contingency period in the actual plan that you get. So they'll be like, oh yeah, we got you. We'll write you up an application. You'll pay your premium. Your premium might be a little high. I'll be quite honest with that. But there'll be some stipulations in the plan that they wrote for you. Okay, so you want to look out for that to make sure that's going to be a good fit. What those contingency plans look like, and I'm kind of jumping ahead on our guaranteed issue, is that it's going to be a 2-year contingency or maybe it's 3-year. What that means is that you cannot pass away from a natural cause death. Okay, so heart attack, stroke, cancer, even COVID, anything that affects your health system, your immune system, you cannot pass away from that underneath these plans. All right, if it's an accidental death, yeah, we'll pay out the full amount. That's fine. Accidental is fine. But natural cause death, there will be a 2 to 3 year contingency period on that. So be aware of that information. That's that red letter language that they have. So they will take you, but if you pass away from natural cause death, they either will not pay out the plan at all, or they'll just return your premiums plus maybe some interest. So that's just returning whatever you paid plus interest. So again, I like that question. I'm gonna go ahead and put that out there. Remind me to get some information on that. Thank you. All right, so moving on. And again, guys, if you have questions, pick up those mics, let me know. I love that. This is good. It's giving me hype now. All right, so we got an application behind me, and what this application is showing you is this is gonna be a regular whole life plan. And that's that information we talked about before. It's giving you the basic information. I put up a John Doe on here. I put the age on John Doe was, what did I put the age on John Doe? 56, I think it is, 1956. Anyway, it's a $50,000 whole life plan. This kind of gives you an idea of what the premium amount would be like for a $50,000 life insurance plan on John Doe at 1965, I'm sorry, at 1965. So his date of birth is 10/5/1965. He's a male. It's $50,000 of life insurance benefit, and the monthly premium is $198.50. It's a lot, right? At that age. But, we're thinking that you might have some money saved up. You already kind of, you know what you need, you know what you want, so you're fine with this. It does have a first month premium of just $1. The reason that is because it's going to go through underwriting. And that underwriting is going to do what? It's going to say, hey, are you healthy enough to have this policy? That's what you're going to be looking at. So as you go down to the information, the key points you want to look at are going to be that height and weight that we talked about before. That height and weight is key to certain things. Diabetes, that's going to be a kicker, guys. You know how our culture is. Diabetes, thyroids, things of that nature, anything that deals with weight. The height is the height, but the height helps us know, the underwriting for the weight situation. So, I'm 6'3", roughly. I weigh 220, say 215 pounds on a good day, but 220 right now because I ate some food. It was St. Patrick's. Y'all know St. Patrick's. All right. So gotta have that corned beef and hash. So 220, 6'3", that's actually gonna be okay. I'm gonna be okay, and I'll tell you my age. I'm 43 years old, so I'll be okay at 43 at that weight. I can probably get a good rating and get a good decent price on my actual plan. But for this individual right here, I put weight of 200, 6 foot. That's good. That's why you're getting that rate right there for 198.50. And so another important thing on these plans is they're going to get into your information as far as your employment history too. Are you employed? Are you retired? Are you disabled? And then are you unemployed? These are questions they're going to ask you. This kind of dips into that finance part of things. You know, can you pay for the policy? Can you afford it for this amount you're looking for? Again, retirement is not going to play too much of a key in that. Employed, you're fine if you're employed. Unemployed, they're going to know, okay, you're unemployed. Well, what do you do? What's your income? And then also for disabled, that's going to be a red flag. Let's be honest with that. If you're, not working because of disability, no matter how big or small, that's going to be something where you might have to have a letter from the doctor if you're trying to dispute that, if that comes up as a red flag and they deny you or they want to ask more questions. So be aware of that. The next question on there is going to be simple. Carrie touched base on this earlier, beneficiary. All right, so it's always important to know who you're going to leave your benefit to on your plans. Be aware of that. The big thing to do nowadays is to leave it to obviously a loved one. You can do charities, such as a church. Or do not do funeral homes. They do not take funeral homes anymore. Okay, it's a different day and age. Funeral homes are still around, but they're closing down. And if that funeral home closes down and they had your benefit, or if that funeral home closes down and they were the beneficiary of your plan, they could take off and run with that situation. They can always watch those obituaries. You pass away, they can reap the benefit of that. And then the new funeral home that took over management doesn't have to honor that. So be aware of that situation. That's been happening a lot more where funeral homes have been closing down or changing management, and they're not honoring the beneficiary status or the assignment of that actual plan. So again, we're not taking those anymore with our company. It has to be either a person. If it's a charity, we can do that, or it has to be an estate or a trust. So those are your ones that we take. Pretty easy to know. Have somebody that you trust, because when you do this, how many times have we done something for ourselves and we just put it away and just kind of kept it a secret and nobody knows about that? And then what happens? You pass away and like, oh, we over here looking for moms, we're over here looking for grandmas, grandpas, dads information because it's time to bury them and we can't find nothing. We're going through drawers and I might have something here, so we're calling around aimlessly looking for that actual information for the death benefit if there was one at all. So make sure to tell your loved ones that you have an actual benefit and it's for it's for them to help you with that final expense. Yes, ma'am. I'm sorry. Go ahead.
When one insurance I had said that my children were automatically on the policy, and then any new children that I had, I didn't have to add them on. Is that still in effect?
Yes, that should still be in effect. What that is telling you there is you have a child rider on your plan. And so what that's saying to you is that your children are covered on your plan. I would have to take a look at that to kind of be 100%, but I am 90% on that. So that's a child rider. So it's telling you is that your children are in your plan. So if you have more children, they'll be grandfathered into that plan as well, as far as being protected by the life insurance, is what that's saying. Now, are you talking about that in that vein, or are you talking about the beneficiary aspect? Okay, sounds good. All right, so I ask you this question. Does it say information about the beneficiary, or is it talking specifically about the life insurance, like your children are a rider on your plan for if you pass away? Like, how's that? Do you know how that's stated? Yes.
Just wondering, do you have to call in and say, hey, I have more kids, I need to put them on the beneficiary part, or does that automatically get split up with the kids?
Great question. You know what? I would want to look at that policy for you, or have somebody look at that policy to see what that is, because I'm feeling that what you have there is going to be something geared towards the actual face amount as far as the insurance aspect of things. For the beneficiary, they do need to have it in writing. So if you did have somebody else you wanted to add to that, you would have to call in and write it down or let them add that child in there. But again, if I saw the language, I can tell you left or right, but I'm thinking it just has to do with the life insurance. So they're just a part of that plan with you. That makes sense. So if when the children pass away, there's a benefit that gets paid out to a beneficiary, which could be you, the parent. But for adding a child, you would have to actually have them added to the beneficiary. Now, I'm glad you mentioned that too. So children, I mean, I'm assuming they're 18 or younger. Yes. Okay. So for 18 or younger, you have to look at that as who is the other parent or the guardian or the grandparent, because if something happens to you, that parent or guardian is going to have the rights over that child and anything that goes to that child as far as money. So this is something you want to be aware of as well. So you either want to have this in a will or a trust, notating how the money is supposed to be paid out to a child, or if the money's supposed to be held until that child hits 18. And normally when it's held, that's good because it gets interest built up into the actual account for the child. So you want to go ahead and word that a specific way, because if it's just in there flat as a child, something happens to you, God forbid, while the child's still under the age, then the money goes to the guardian to deal that out to the kid. And if they don't know who that person is, or they don't have a really good relationship with them, that could be not a good thing.
I'm sorry.
Go ahead.
I don't know if I'm jumping ahead or
You're
in the
fine, go ahead.
program, but you made me think about the next question, because you said some funeral homes are going belly up. Well, what about the insurance company? If they go belly up, where my money?
Well, that's it. Thank you for having me out, guys. It's great. No. No, that's a great question. I get that every time. Like, how long you guys been in business? I just saw you on TV. I just got this in the mail. How'd you get my name, my address? And we had to go through that spiel because at this mature age that we're at, they see you guys out there. They see you. They see you through, you applying for your Medicare or any type of health insurance out there. They sell off your information, so they see you. And anybody can grab that information and pretend that they're a solvent company trying to sell you ABC type of product. And so we get that when we advertise the same type of thing that Colonial Penn advertises. Why is it not $9? Thank you, sir. He gets it. But that's the deal. I mean, that's a legitimate company, but the reason they're doing that and how they're doing that is just, what could be known as clickbait on social media, but for us, it's just an enticement. It's propaganda, as we know in our age. And the marketing pieces are there to entice you. So to answer your question, you don't know that. You want to do your research to make sure the company is a solvent company. It's been around for a while. Physicians Mutual has been around since 1902 or 3. Thank you very much. All right, I got it right. 1902, so they've been around for a while, so you already know what their lineage looks like. But they're there, and they've been paying out their clients for years on end, and we haven't had issues with them, or with the company, excuse me. But there's other companies out there that you do need to scrutinize, So even those companies I mentioned earlier for those guaranteed issues, they've been around for a while as well, but there's other companies that look like them that haven't been around for a while that might not have a good rating out there. You want to look for a company that has an A+ or A++ rating. And that just has to do with their finances, You can find that information online, or if you need help with that, definitely reach out to somebody like myself or even Carrie. We can always help you with that information as well. But if you're looking for insurance with a company and you're not sure of how solvent they are, and if they're going to take off and take your money and close out tomorrow after you get that, definitely want to find one of us to help you out with that information.
So you're not like insured like the bank?
Ooh, good question. So FDS, yeah. So yeah, not necessarily. I mean, with us, we're mutual. And so mutual companies versus corporate companies is totally different notation. So we're here for the investor. We're here for the actual clients, not the investor. Mutual, when you see Mutual of Omaha, you see Physicians Mutual, that means for the people, versus these other companies are for profit. So they have to meet for their investors first before they pay out to anything that happens with the client base, or if that makes sense. So we are for the people, we are for our clients in that vein. We do pay out, 7 to 10 business days after a claim's put into process for us. And you can always find us. We're on the block. You know where we're at, over there, right there by Creighton. So we haven't gone nowhere. We bought the old building, which was the old Enron building. So that just shows that they have solvency in that scenario. But we're not going to be that company that just takes off and runs with anything from you. We're always here to reply. And I'm going to give you my information too, so you can talk to me directly after this conversation is done with. But I like that question, love. Thank you. All right, so yeah, go ahead.
Question.
Go ahead.
I'm listening to you explain term life versus whole life. What would be the advantage of getting whole life versus term life?
Good question. All right. So I kind of touched based on that a little bit earlier, but I'll go ahead and expound on that. So the difference between, what's the advantages? Good. All right. Thank you. He said, I don't see an advantage in term versus whole. The advantage in term is just going to be where you're at in your life. If I was in my 20s, if I was in my 30s, and somebody approached me about insurance, what they would have to do is sell me on my needs and for what my future needs are going to be. There's no advantage for it for the future if you don't understand what that looks like for yourself. I'll explain. So if I know I'm going to get married, have kids, get a house, get a car, because that's just kind of what those things we should be doing in life are, that's what they tell us in society, then you want to make sure you have that. Now, your company that you might work at the time frame might have insurance. It's normally going to be term insurance. Definitely want to grab that because that's free. It should be free, or it might be like $5. Grab that because it's free insurance, for the lack of a better word. But you want to find out, how to make that base solid for yourself. So whole life is going to be the best fit for anybody, especially when you're youthful, because it earns cash value. You keep it. You own that policy. It's going to definitely pay out to your family members in that scenario that we just talked about earlier. And it has some different riders that are built into it. Even that rider that I believe that she was having up there with the children, it has a lot of caveats to it that helps out as you continue to mature. It matures with you. Whereas term is just a kind of cutoff. It's just like just like renting. You're not going to have it for very long. So I don't know if I'm really talking, with the whole term policy. I just know that it's a good benefit at certain points. So here we go. So the only reason I use term policy, me personally, is again, I told you I was 43. And so I have a term policy and a whole life policy all combined in one. And what it does for me is that it's my time frame where this is my go-go years. I'm out here, I'm doing things. It helps me to have a larger face amount. So I'll do the math on that. So $365,000. Not all that's whole life. That would be a big premium for me for $365,000. So how about I just get a $50,000 whole life, and then do everything else in term. You can do that. You can make a combination piece of your plan. Okay, I'll just do simple math. We'll do 300,000. Excuse me. So you just do 100,000 of whole life and then 200,000 in term. So that way, when you get up to 65, and that's how my plan works. When I get to age 65, that term policy is going to go away, and I'll have 100,000 because by that time frame, my debt's going to be done. I hope to have my mortgage paid off, cars paid off. I only have one kid, so I hope she's good and gone in school. She's a junior right now. So all these things will be paid off in my mind, so I don't have to have as much. That's the important part about term life. It gives you all that amount up front while you're youthful, but as you start to take away all those debts, those liabilities, you get to the really nitty gritty of things. So if you have a home, that's an asset within itself, right? Awesome. If you have any type of 401ks, if you have any type of investment, that's an asset within itself. So that's something that your family members will have to work with. I'm not trying to leave anybody rich. I know. I ain't trying to leave anybody rich, but I want to make sure they're taken care of as well. And that's what that does for me in that scenario. My funeral expenses taken care of. If I do have any outstanding debts, that'll be there as well. So you can do the term and the whole life in a combination deal for yourself. That is something important that you can do. A term by itself is only good for a certain limited time. I like to see that again in your youthful stages, in your more mature stages. I don't think it's going to be a good fit for you because you want to do the long play, because we don't know how long we're living nowadays. And I think we've been expanding that out each year. We had a hiccup 2 years ago, but now it's like, we're back into the go-go time frame, and now we're living a lot more longer if we pass this last 2-year period, trust and believe. So term, only good in your youthful time frame, unless you want to make it a combo deal with whole life. And then the whole life is just better to go with. Get into it as soon as you can, if you can.
Thank you. One last question.
Go ahead, sir.
Is there any way to find out if someone has life insurance and you might not know exactly whom they have it with?
Great question. So you were saying, is there any way to find out if somebody has life insurance and you don't know who they have it with? No, there is not. So that's why I go back to that question about the beneficiary statement earlier. You make sure you have someone that you love and you trust, and tell them where it's at. Tell them where all your information's at. My mother, 66. I've sold her everything but her life insurance. I sold her long-term care. I've sold her Medicare supplement plan, and I've got her taken care of with her transition, because she's working right now, but she's trying to max out her Social Security. So she'll be working for until 67-ish, maybe 70 if she still wants to do it. But with that being said, there's a black box. There's a black box. It's going to be here in this basement. It doesn't move. I add to it. I don't take away from it. If something happens to me, that's going to be everything you need to know. You don't have to dig through anything to find it. So make sure you have somebody like that in your life where you can find that information, and make sure you have somebody you can trust to tell them about that. That's important too. Our trust issues sometimes, our trust issues, thinking somebody's always going to do one over on us. That's so important to understand that we have to have somebody in our life that we feel comfortable with that's going to take care of us when we're no longer here. So that's important. Yeah, there's no way to find that. I have people all the time from calling the company saying that we found this, or they had this in their wallet, and more than likely you're not going to have the information in your wallet. They more than likely have a marketing piece from our company that they meant to call on, but they never called on. And so now they passed away, God forbid, and now their family member found that in their wallet because that's the only place they knew to look. And they're calling to ask if they have a plan, but they're just fishing around, or they see an account debit. I think this place. It says mutual, so we're calling all mutual places. So make sure you tell somebody, your loved ones that you really trust, that you don't have to be concerned about, like, hey, I have this here, take care of my business. So, yes, ma'am.
Do. Like he said, say for instance, they do have a policy and you can't find it. How long do you have like a moratorium time that you got 5 years to find the policy before you can cash it in?
Good question. So that's a good question. So this is what's going to happen in that scenario. So if you can't find a policy and
You got a policy.
you got a policy, it's been 5 years, and it's been a long time, and somebody finally found it, but obviously you ain't made a payment on that, right? So it's already lapsed out, assuming it was a policy that you're making a premium payment on. That actual death certificate is going to let us know, exactly. That's the only way you can trace it back, because that policy might be, excuse my language, dead and gone. But if they found it, stumbled upon it, and it's actually a policy that was still being paid on, but now it's lapsed out, but you can prove that that policy was in effect at the time from that person. Yeah. So I'm gonna finish that. So if you can prove that policy was in effect by the time the person passed away, it's okay. But it's still you don't want to be looking for that. You want to make sure somebody knows where that's at, right? Yes, sir.
I would like to ask the question
Go ahead.
about a long-term care policy.
Okay.
I've been paying on this policy for at least 12 years, $330-some a month. And I checked to have, quite a few $1,000s in there. But my question is, if I cancel that policy now, can I still receive benefits from what I've already paid in that policy?
You cannot. No.
Oh, Lord.
Yeah. So this is a conversation that needs to be had prior to the fact. So that long-term policy, and you sound good, you look good, The point being is that it's going to be there for as long as you're living. You cannot cash it out. You cannot cancel and get any money back that you put into it. It's supposed to be used for your term as you're still living. So this is one thing about this. And it goes with the inflation too, maybe if you have that in your actual plan. But with my mother's plan, we have it to the point where if she ever becomes disabled, not able to work, or has an issue, I'm not putting her in a home. I'm not putting her in a senior home, nothing like that. That policy will pay out your loved one to be trained and to take care of you. So I can leave my job at Physicians Mutual and take care of my mom for the rest of her time being, because that policy pays me to take care of my mother.
So you're saying if I get sick, that policy will pay my wife to take care of me?
It'll pay her to take care of her. If she's going to be an acting nurse for you, acting caregiver for you, it will pay. Yeah, so you don't have to go to a facility. People don't understand that. You don't have to go to a facility. That policy will actually pay the person who's taking care of you to assist with your needs, because she is your acting, caregiver. So that really mitigates that point. So people don't understand that. Yeah. So yes, ma'am.
Is there a term on that type of? Is there a term that
No.
run out?
No, because he's paying for that. It's like health insurance for him. I mean, so he's paying for that, even though he's not using it right now. Yeah, sorry about that.
I was just asking if it like ran out, like she's getting the money to take care of him. Is there like just forever until?
Well, I mean, once it's activated, it's activated. So, I mean, he's been paying on it. He hasn't been using it. I mean, it's there for that reason. And so once it's activated, it's going to keep on going, I mean, notated I hate to say this, if she's taking care of him, he's probably on the downward slide, right? So it's going to have he'll pass away. So they already know that information, obviously, through the medical. But as he's doing that, you don't have to put him into any type of care facility. They'll pay you to take care of him.
You still have to pay the premium.
At the time frame, the premium will stop at the time frame, but I would have to see the policy though, because certain policies will have a small niche in there, but the premium will reduce or it will stop because now it's the policy's active. So, good question. It just depends on the policy type.
Now, can you
So I need-
change your policy? Far as if you have a whole life or a term life, and you want to go to a whole life, what you have already paid into that term life, can you just switch that over to
Yes, sir. You
your
can.
whole life?
You can. You have a certain time frame. Normally, it's like 7 years prior to, or 7 years within the term policy. But you can what they call convert it. So it takes your value. Now, notate there's not going to be cash value, but you can start from zero with the term. But it's going to allow you to convert the policy and with no health questions, with no exams. So when you got in a term policy, you're at the most fittest point of your life. And so now maybe you for lack of a better word, you caught ill and you want to convert it to a whole life. They allow you to do that without any health requirements, so no underwriting, but you will be doing it at your attained age. So whatever your age is, that will change your rating, but you can do that. Question. Did you have another question, sir, earlier? Okay, sounds good. All right, good questions. Yes, ma'am.
I have a question.
Go ahead.
How many policies can you have with one company?
Good question. So depends on the style of policy. With the modified life with the final expense, you can have up to $30,000 in most companies worth of a final expense plan. So you can have 1,000 with company A, 1,000 with company B, 1,000 with company C, or you can just have 130,000 with company A. So that's that. Now, if you're doing a regular policy like a whole life or a term, you can have 100,000. You can have several policies within that if you get underwritten.
And the reason why I'm asking, because someone, even in my family, had like 3 policies, but the next question, what would cause one of the policies to be canceled? Could it be maybe the health have changed, but the other 2 were alive, but I'm just saying, the third one was canceled. What would cause, what's the stipulations of what would cause?
Shouldn't be anything with the health. The health should be the last thing that's notated there. I'm gonna say premium payments, always the major cause. Premium payment missed, lapsed, whatever the case may be. That's the reason that policy would be canceled. Or if it's a term issue that's just reaches term. But there should not be a reason that the policy was canceled due to health, because you're already in the policy. You already got underwritten, and so your policy is good for you as long as you pay your premiums on that basis, monthly, quarterly, semi-annual. So I'm gonna say it's a premiums because they won't cancel because of your health. You can get sick, but that's for lack of a better word, illegal for them to do that. So if they did do that, there's a litigation you can have in that scenario. Good question. Yes, ma'am. Yes, ma'am. Press that mic. There's like a gray area on there. Yeah. Here comes John.
Okay. A lot of times parents have insurance policies on their children, and the parent is making the premium payment. Okay, so if the parent should die, I understand the premium won't be paid anymore, but with the children, do they cash out that policy, or do they have a chance to buy the policy, or?
Great question. So you're asking about the policy that's on a child where a parent is the payer of the plan and the parent passes away?
Parent's the owner, yeah.
Okay, parent's the owner and the parent passes away. Well, first of all, is the child aware of the policy? Again, that goes back to our conversation before.
Okay, you could assume that
Okay,
they're
assume that.
aware
Okay,
of the
thank you.
policy, yeah.
All right, so if they're aware of the policy, then yes, they can do that. They can submit a death certificate, death claim on that notating their parent, and they can take over ownership because they are the insured of the plan. Unless there's a different stipulation built into that, notating that somebody else is going to take that over. That can be an assignment saying if I pass away, then it goes to the dad or grandparent or guardian or whatever. I'm assuming they're adult children, but the adult child can take over the premium payments and become the owner once the parent has passed away.
Okay, but they also have the option of cashing it out too?
They do, yeah, they do, because the payer is passed away. So now as they're still living, being the insured, the child being the insured, once they take over ownership of their own policy, they have the rights to the plan, correct?
Okay, and the other question I have is, it has to do with lump sum payments. You're talking about 100,000 50,000, 300,000, so forth. The insurance companies actually pay that amount, or do you have to take out an annuity?
Good question. So they always try to keep the money in house, right? I want you to, you get 100,000, but if you want to keep it here, we can give it to you a certain time frame. So just like winning the lottery, that windfall, they try to keep it within the company and keep the business there. They don't want you to take all of it, because we talked about the only way they make money is by keeping the money in house. We don't want you to pass away or your family member to pass away. But since you did, here's your check. But so they give you the option for annuities. That is one of the options in the sale process when they're filling out, when they give you a claim. But you can take the lump sum if you do want the lump sum. But that's an option.
Okay, and so what if you have the annuity and you want the lump sum? Can you go back and change it?
I think that'd be company specific as far as that's concerned. But I understand what you're saying. So you're saying if you got the annuity, but you want to go back and get the whole amount now?
Well, okay,
Okay.
what I'm saying is a lot of times when you're dealing with insurance companies, you know, you have your death, you know, you had a death and you don't always know what you're doing.
Yes.
You don't always understand
Yes.
what you're doing. And then sometimes people take advantage of you, you know, well, sign here, you
Yes.
know, and you don't even know what you're really signing and so forth.
I
That's
got
how
you.
come I was asking, can you go back and
No, okay.
change?
Yes, ma'am. You know, I love that. I love that. So, I mean, what she was saying that, you know, you're not in your right state when a family member passes away. And, you know, a good agent, a good rep would meet you where you need to be met. You know, if it's not the time to, you know, talk about this, or if you're able to do the, you know, burial without the check, then let's talk, you know, 2 weeks from now or whenever you're ready to talk, so we can talk about your options. But when they get you right, when something happens, it's like, yes, we need this money for the funeral, and they told us this. So to answer your question, yes. So you can get out of the annuity, you know, but you're going to get probably taxed on it. And that's going to be the thing about that. So if it's built any type of interest, or if it built up any type of exponential money outside of what the actual amount that was put in it, there's probably going to be some taxation in there for you. So you have to look at that. Because the annuity is there, it's sitting there, it's giving you out XYZ over a year or 6 months, or however many, however many criteria you put. There's different styles of annuities. So look out for the taxation aspect of that once it hits the annuity, but you can get out of it. You would have to speak to your advisor who sold that to you to kind of see those stipulations. So if you want to get out, you can. There might be some taxation in there for the money that's accrued interest. That makes sense? Okay. He said no. Let me say it again.
Yeah, I'm sorry, it doesn't make sense
Okay.
because they're giving you a payment.
Right. They're
And
giving.
so I'm assuming that that's the interest that they're paying you, and the lump sum is still sitting there from the original amount.
Oh, I see what you're saying. I see what you're saying. Yes. So you're saying on the interest payment for keeping the lump sum in there, but you're not being taxed. I'll probably take a step back from that conversation piece, because what I know of it is that there would be some taxation for it to be in there to come out for a cancellation, or some type of penalty, like a surrender penalty is what I'm speaking of. So I like what you said. You're challenging me on Saturday after that. So let me go ahead and go to go up one notch higher and put a pin in that. And if I can get back with you and get your information, so I can give you a clear answer on that. But you challenged me on that one. So I would like to see if there is a taxation. If you do have a good example for me, I can take a look at. That would help out too. So I appreciate that.
Is it, I see, what I learned growing up is like I would watch other folks of other colors get insurance on their children as soon as they're born. $1 million policy. It's supposed to be low payment. But that wasn't shared with people of other color.
Right.
Is that something that we should look into and keep it going as we see that other races have done?
Yes, and yes. We don't talk about we don't talk enough about the pillars that it takes to build our wealth within our community. The Jewish do, the Asians do, the Hispanics do, all other races around us, because we bookend them, blacks and whites, we bookend everything. They talk about generational wealth, and they keep it to themselves and they share it within their communities. We don't do enough of that. That goes back to that conversation. You know, tell your family where that policy's at. Tell them, you know, let them know. Just don't think you're hiding and hoarding this information for yourself and then hope they find it. Give it to them while they're still living, you know? and make them understand. Maybe you shouldn't give them everything, but give them in small increments. Have those talks after church. Have those talks on Saturdays. Have those talks when somebody is not at their most highest point of being busy or distracted. Those are the best time to have those conversations and let them know. Yes, buying policies on children when they're at their most youthful state, is the best. A Gerber policy. Shoot, having something besides having nothing is always important, but I don't know about how high you get. You don't need to get $1 million on a child, but you can get some high amounts, for a small child, between 4 weeks to 12 years, because really you want to have something for them to be buried. God forbid something happens, but as they keep on reaching up to these different heights, age-wise, the policy can be advantageous because we talked about the compound of that dollar, of that interest in there, kind of like towards that annuity conversation, but more like buying that now while you're youthful and seeing it grow later on. So that's how you get to that $1 million when they're 30 or when they're 40 years old, by having those policies at a lower amount, and then tell them how to invest that as well, because insurance is one part of it, but there's other pieces to that vehicle that can be talked about. But that's a gateway into just managing your personal assets and your business assets. If you choose to go out and become an entrepreneur, you have something to show for that in your savings. Plus you have this life insurance policy that back you up when you want to purchase a home, etc., that you have a loan on there, or you can buy a car with it, etc. So those are different things that we can do to build this wealth up within our community, but we need to talk about it first. And this is the first step, guys. We need to go back to our children, back to our grandchildren, and tell them what we heard today. It's cold, so they shouldn't be outside right now, but catch them when they're at the most attentive state. Just don't whomp them over the head with information, but have them talk at the dinner table, or when they are very open to that conversation, and see how you can build on that. Because you're right, we lose that every time. We miss those opportunities every time, and we wonder how said person on our right got to this point and this level because they had that conversation within their family. Unfortunately, we don't share it with other families within our community, which we need to. So I think this is a really great start. Hope we have more of this too, by the way, and invite more financial advisors here to talk about not only insurance, but also investment, also real estate, etc. I'm pretty sure Carrie's gonna get that together. So, but I love these are great questions. Only I have one that stumped me so far on the annuity question. So I've been doing good. So we talked about the beneficiary information. What's my time look like right now? How long for time? Okay, cool. So I wanted to kind of show you a little bit more about this application, then we'll kind of wrap it up for any more questions that you might have, but you guys have been hitting me with a lot. I love it. So this is the meat and potatoes of the whole life application that we were talking about before. And I'm really drilling down on the underwriting aspect, you guys, because this is the important part. We can definitely have the conversation about face amounts, about needs, etc., but you won't be able to apply for this beyond the conversation if you don't know what your actual your health is and what the questions are going to be. So in this case, this is a very general notation, but this actually blankets almost anything an application can tell you. And she was talking about the risk aspect of things. This right here is not going to play to that. This is going to say, hey, if you got any of these things blanketed, you are declined. If you say yes to any of these things. So some of the information here, again, I'll read it to you because I know it's blurry up there. One of the things in here is, have you been treated for any of the following in the last 10 years? Have you been treated for any of the following in the last 10 years? So this is why I have to read off to people verbatim. Heart trouble, high blood pressure, stroke, cancer, diabetes, chronic lung disorder, mental or nervous disorder, drug or alcohol abuse, epilepsy, sickle cell anemia, kidney or liver trouble. So pause on that conversation, think about what I just said. I had to spew this off. 10 years, not just like in the last 5, 3, 2, 10 years. Disqualified if you say yes. All right. Yeah, so yes, sir. So you already know. So I mean, we already talked about the HIV. That's kind of a no-brainer in that scenario if they put that in the question. The next one there is in the last 3 years. So you see how they narrow it down. They hit you with a broad question, and then like, okay, you passed that one. Okay, HIV. Most folks, we don't have too many of those calls that come in, but so you get to the next one, they narrow it down for you. So in the last 3 years, have you consulted a member of the medical profession or received medical or surgical care or taken prescription medication for any condition other than those noted above? Man, we all take medication of some sort at some time. Let's be honest with that, right? So, I mean, if you had any of those issues in the last 10 years and you overcame those, that's great. But now, do you take any medications besides that noted above? Again, very broad questions. And so a lot of people hear that. You're not being specific in the questioning. So, like, you're going to say yes. Again, more likely that'll be a decline as well, or they'll have to look at that through underwriting. And the last thing here, this one's in the last 12 months. Again, they narrowed it down, 10, 3, 12. So in the last 12 months, have you received or applied for Social Security disability, supplemental security income, workers' compensation, or other disability benefits, or been confined or advised to be admitted to a hospital or nursing facility? All right, so if you didn't get you on the 10 years, if they didn't get you on the 3 years, or they're gonna get you on the 12 months maybe, disability, we have disability issues. Social Security disability, supplemental security income, things like that, they question. So again, that goes back down to your finances. So these are things that are knockout questions for a whole life policy, original whole life policy. Is that it? All right. So that's that right there. A second, go back here. A second.
Question.
Go ahead, ma'am.
What about you go to see a therapist? If you go for a free therapy, do they submit your stuff? But if you go to a paid therapy, they now have it?
It depends on what the answer to that question would be when they ask that. So if you're saying you're going for therapy for depression, it throws up a yellow flag, like, okay, you're depressed, we get that. And what's the issue? It's the question. Now, do we ask that in full? No, we just ask, who are you seeing? What's the name of the therapist, address, and we'll figure that out, through the underwriter speaking to that office. But that's the question. So it'd be a yellow flag as far as if you're going to therapy, like what's the reason? Is it for anything suicidal, tendencies, anything of that nature? Again, that would be a red flag in that scenario. But if it's anything else, any type of counseling issues, it would either be a yellow flag or it'll let you go past with that. So, and especially right now with mental health being what it is, there's a lot of things that are getting passed just because we understand that we need to talk it out before it gets to that point where it is an issue. So they're okay with that versus before, I think it was more of a thing where it's like, no, you're going to therapy, red flag. So they're being more lenient with that. Great question. So then that was everything on the actual whole life information that we just talked about there on the application. We went through a lot of the questions you guys might have had at the end throughout our conversation. So it's like, I really don't have too much to say or ask on that point. But I will kind of go back to that guaranteed issue because we talked about the term policies. We talked about the whole life policies. We talked a lot about, everything in between that, between your questions that I've answered. But going to the guarantee issue, this is going to be my big thing, my big seller through a lot of my conversations I have on the phone. And the guaranteed issue information falls on the final expense that we talked about or the modified life product. Now, this is our big seller with our company because it's what we advertise a lot through the marketplace via mailers. And this is going to be that information that we talked about as far as high risk, so you can get into this plan between age 45 and 85 is where we allow individuals to apply for this plan. This plan goes as high as $20,000 for the face amount, and it goes as low as $3,000, and we do all increments in between that in the $1,000 face amount. So it could be 4, 5, 6, 7, 8, all the way up to $20,000. There is no, it's unisex rate for the most part, as far as, sorry, not unisex rate, but it's a non-smoker rate as far as that's concerned. So there's no issues with type of tobacco use on here. And the only thing that is a play is going to be your sex and then your age, male, female, or your age. How old are you? Other than that, you are guaranteed this plan. So that stipulation of what we talked about earlier with that 2-year contingency, that's the only thing that would be the caveat to, do I go with this plan or do I not? It's a whole life policy. It will be with you for your whole life. Okay. You pay on this premium, it will be with you until age 120. I talked about that earlier. So if you live to 120, policy will still be there. But the caveat is that in the first 2 years of this plan, if you pass away from a natural cause death, the policy will only pay back the premium that you paid into the plan plus 10% interest. Okay, so if you pass away from a natural cause death from this guaranteed issue plan, it will pay back your premium, whatever that amount was, plus 10% towards that. 2 years, natural cause death. After that, doesn't matter how you pass away, natural cause death, or it could be accidental death, policy does pay out the full benefit. Go ahead.
Is it really worth getting accidental insurance?
Good question. That's my next. You're ahead of me. I love that. So good question on that. So this is something that we always offer with this plan as well. Is it really worth getting accidental death insurance? I say yes, because it's not as much, and it depends on the style of policy. In this case, I can speak to ours. Our policy pays out accidental death from pretty much any mannerism of death. You have to pass away within 90 days of the accident happening. So if you, God forbid, fell off a chair in a home, broke your hip, were in the hospital from that, passed away 2 months after that, the policy does pay away accidental death. And so it doubles the indemnity for you. Okay, so instead of 10,000, it'd be 20,000. Or if you have 20,000, instead of 20,000, it'd be 40,000. It's only roughly $2 to $6 more added to your monthly premium. Now I say this, sounds easy, but you are mature now, right? So you have a fixed budget you're living on. You're not working no more. All right, and so you just got it through your mind when you saw that premium amount originally that, oh, I'm gonna pay this, I'm gonna be good to go. And then somebody upsells you to that accidental death for just $2, maybe $6 more. You have to really dig deep. You have to really dig deep to see if that's gonna be a good fit for you. A lot of people say, hey, I don't wanna leave anybody rich, or whatever the case may be. Like, it's not about that. It's about making sure your benefits are taken care of, plus, if there's any other needs that need to be handled in the household, it does give out extra benefit to your family members or your children in that scenario. But I do think it's worth getting accidental death. It's not that much. If you don't like it, or if it's not a good fit for you, there's no reason for you not to like it. But if it's not a good fit for you as far as your budget, you can always remove it, and it does not affect your original policy. So I say yes to accidental death. Get that feature.
Okay, I'm just giving it. Like I heard one time, let's say somebody had a car accident,
Okay.
but they had a heart attack. Did they have the heart attack before the car accident or after? And then like, well, we're not paying. You know what I'm saying?
I know exactly what you're saying. This is what I deal with. I'm gonna keep you in my pocket. We're gonna do some marketing together. You, me, and you, girl. So yeah. So if they had a car accident and they had a heart attack, so what that's gonna look like for them is that the heart attack caused a car accident, right? Because they were driving, they had a heart attack, and then they caused a So that's easy. I mean, so it would go chicken or the egg first? What came first? The heart attack came first. Their health. Right, so the health caused the accident. The insurance itself will recognize that for paying out so it would pay out the full benefit amount as far as what they applied for. So we'll say they applied for 20,000. Okay, they applied for 20,000. It would pay out the full benefit amount if they had a heart attack. But were they in that policy for 2 years plus? Or were they just in it for first year, first week, or whatever? If they were in it for that first week and they had a heart attack and passed away, in that accident, the policy would only actually pay out the amount that was paid in plus 10% interest because they had a heart attack, caused an accident, but that heart attack was a primary source of the reason why they were dead, right? We assume. So I'm not the coroner, I can't say, but if they already were in the plan for 2 years plus, the heart attack would still pay out the 20,000, and then the accident would be up to debate to double that amount for them, but at least they get the 20,000. And then if the accident notates the double indemnity, the insurance company would pay out, but it's going to be scrutinized by the underwriting to make that decision call on there. So the first part, the heart attack takes over precedence. Second part, yes, it was an accident, but where were they at in the term of their policy that they were in when they applied for that and they had that death occur? And then if that was over the 2 year period, then the heart attack will pay out full amount for them. And then the accident would be looked at by underwriting to see if that would pay out additional amounts. So two-side story, but I would say, to kind of make a long story short, the heart attack would take precedence over whatever that payout would be. Okay. Good question though. Dang, a good question. All right. So yeah, that's what we hit all the time frame. Well, if I did this and then what did this happen to? Those are questions we answer a lot. And the notation is that it would be an underwriting question. A lot of people, that doesn't happen as much, but it can happen. Anything can happen. We see that in today's time. So I'm gonna switch back over to my other deal here. So John, bear with me, my friend. Switch back over to the other slide because I'm done with this application information. You guys have any other questions while I'm doing this real quick? Any other questions that arise in your head or anything that I did not answer to your liking? Or you just don't like me at all? What's up? Just tell me whatever. It's a Saturday, it's not a Sunday. You can tell me what you feel. that question come on.
Question.
Go ahead, sir.
I'm reviewing insurances. Explain how vital and important it is to understand when the policy will take effect. I've known some people that got policies and they said that there was a 2-year waiting period.
We just talked
and then
about that.
some that are instantly upon signature of the application. Is that something that's not talked about with the agents?
Yes. So yeah, that's important. So we talked about the insurance and how important is it for what takes effect on that. So we talked about the 2-year contingency period, and that's a caveat that lets consumers know, do I want this plan or do I not? They come into the conversation through the marketing pieces, assuming that it's going to be day one coverage, because everybody wants themselves and their loved ones to be covered if something happens to them from day one. Why not? I'm paying for it. I own it, right? I gave you the money. It should pay out right away. But with those guaranteed issues, it's not the case. So you have to figure out, again, it goes back to a needs basis of, is this going to be a good fit for me, but it's going to be a good fit for my family. And do they understand, again, by talking to them and letting them know what type of policy you have, how the policy works. Of course, we all want the day one payout, but you saw the stipulations that I said earlier for the day one payout. That goes with even term insurance as well. You do have to go through those health questions. No matter how big or how small, they're going to scrutinize that and they're going to look at that. And getting your information, just quick information about your doctor or your clinic you go to or your physician, along with pertinent information. We don't even ask for your social security number, just your name, date of birth, and your address. That's all we ask for with our company when doing that information search, and the underwriting does the rest of the legwork to qualify you if you get that day one coverage. But you will be scrutinized. I hate to use that word, it sounds like a negative word, but you will be scrutinized as far as your health for that day one coverage need. So it's important. You want day one coverage. I want you to have it. I want to have it for myself, but not all of us can get it depending on the stage that we apply for the plan. So again, the earliest you can apply for that is the most important thing. Or if you just know that it's going to be a need basis, where it's like, I know I have this 2-year contingency period. I'm gonna bite the gristle. I'm gonna go ahead and get this plan. It's easy to apply for, and then hope God blesses me with 2 years. I'm good, and then the policy will pay out right away. So I want you to get that right away, but unfortunately, we all can't afford that just due to our own health stipulations. Age is not a thing. If you can afford it, you can afford it. Sex is not a thing either, male, female. It's just that health stipulations. I don't want you to be denied, because once you're denied, it's gonna be hard for you to get insurance anywhere, because they see that whole record. So it's important to get day one coverage, guys, as much as you can, and know how your policy works. Just don't get it because of that face value. That's another thing. We talk about wealth management. Everything that glitters is not gold. Just because it's $9.99 and it's on TV and they got somebody who looks just like me is trying to sell it to me, just like me, doesn't mean it's that value add. Figure out what that looks like for you. I buy from a white man, an Asian man, a Hispanic man, just as much as I buy from a black man. Don't put that in front of me just to make me seem like that should be the way I go. So do your math. If they put it out there in front of you, and then I'm taking a question. If they put it out in front of the court shows, if they put it out in front of the talk shows, if it's on a time frame in the day where certain people are watching and it's not everybody watching, that's something to put up a flag. Just it's marketing. I get it, and everybody's got to make the money advertising wise, but I harp on my mom. I'm like, I see this commercial come up and she's looking at it like, nah, don't you pick up that phone. Don't you call nobody. Don't want you to do it. Go ahead.
I just wanted to share. I talked to Mr. Jonathan, and for the $9.99, I had him go through the whole process. You might get $500.
There you go. That's right. You might get $500 because it's just the way they dictate the pricing on there. So they got the ugly lights up on me, so I don't know if it's time to go. But narrowing that down will keep everybody's time good at this point. So we talked about a lot when it came to applications. I think a lot of it was filled in by your questions, which were great questions. I hope you guys got a lot out of this information today. Again, my name is Elliot Harris. See, this is your thing. It's not my thing. As if you guys want to reach out to me, first of all, this is my agent right up here, Carrie. She's my agent. But also, again, my name is Elliot Harris. That's ELLIOTT.Harris. This could be my email address. So that's Elliot, ELLIOTT Harris, Harris, at physiciansmutual.com. That's at physiciansmutual.com. Email me. Email me your thoughts if you have any questions. If you forget that name, Carrie's going to be my liaison in the whole deal. Let her know how you feel about this conversation. Let her know you want to have more conversations just like this, because I feel this is value add today. And I appreciate you guys for coming out in this weather as well. Again, I think I covered a lot of the information here. Did I miss out anything? No? Yeah? All right, thank you. This is all right. We already did all this, so. All right, well, I appreciate you guys for coming out. Stay warm, stay healthy, God bless. You guys been great. Thank you for your time. Appreciate you guys. Thank you.
Can I ask a couple questions?
Go ahead.
I don't know if I missed them or not. What is the average cost of a funeral, whether it's cremation or just a regular funeral? What would be the average? Do you know the average cost that we should have at least on hand?
Yeah, let's go ahead back up there. That was the slide earlier. So
Okay.
it was right here. So you can see that it's going to be average funeral cost is going to be in Nebraska. In Nebraska, be around $8,500 for the average funeral cost. For cremation, you're looking at around $7,000. We'll call it 500 or 600.
So what is that they advertise you can get cremated for $1,000?
Well, we're going to have to go talk to them because I only know
Okay.
insurance. I only do insurance. I don't put you in the ground. I don't cremate you. But I mean, it can be cheaper, but you have to look at the whole outlier on that.
Okay.
And be careful with that stuff too, because you're not going to be here. Your family member is going to be here representing you when that happens. So again, just like he was saying, call, figure out the information ahead of time if you can. I'm not very versed in talking to funeral homes. That's not my business. It's the claims though, and it is selling the actual insurance. So I always try to say, make sure you know who you're dealing with or your area. And the best way to do that is reach out to your family members, ones you trust, and let them know that you have something on yourself as far as a policy or some type of benefits, just in case when they do leave this earth, they can find that easy.
And then my last question
ahead.
is, do you have to disclose to programs that you have insurance? Because there's sometimes they be asking, you got insurance, you got life insurance, what you need to know for?
So say that first part again, please. Do you?
Do you have to disclose that you have life insurance to like programs, government programs?
Ooh, good question. Good question. All right. So yes, you do. The government programs, you do. Yeah, I understand. We go back to that. Why you my business? Why you need to know all my business for you? We're just doing this type of work. But you do need to disclose your information to them if they're asking if it's a government program that you're talking to government, because you have life insurance and you have the whole life plan that we talked about, or even a final expense plan. Remember, we talked about the whole life does build cash value. They want to know how much cash value you have in your plan. Okay. You normally can only have up to 2,000, sometimes 1,500 max. Okay. And then if you have that, they want you to cash it out, or they want you to, period. They want you to cash out the plan. They don't want you to have any value if they're giving you money. All right. So I'm going to say that again. If you have a life insurance plan, whole life to be specific, and it earns cash value, they don't want you to have that, because they want to make sure that they, for lack of a better word, are controlling your income in that scenario. So they're going to ask you to cash that information out. The way you get over that is that you have to assign that plan, that policy, to someone else so that it's underneath their actual tax code, their social security number. Okay. So they don't want anything pinging off of that, because that whole life policy you have builds interest and it builds cash value. So anything over $600, it starts to build interest for you, and it starts to ping on that tax on the social security radar. So they can't really see it until you pass away, but they already know it's there if you have it. So they ask you that question. And you have people call us in all the time frame from the government agency offices saying, I'm looking at Mrs. Smith's stuff. I want to see if it's a valid policy, or does she have a policy with you, to confirm that she does or she does not. That can disqualify you from whatever government assistance you're looking for. So you have to watch out for that. If you do have a policy, you want to keep that policy, you have to take it out and assign it to another loved one. You still be the insured, but that person would be the owner. That's kind of going back to what she was saying earlier a little bit. But yeah, it cannot be underneath your name as the owner. You can be the insured, but you cannot be the owner of that plan. Good. You're welcome. Welcome. Anything else, ladies and gentlemen? No? All right. John, we good on we over there? All right. All right. So once again, my name is Elliot Harris, guys. I really appreciate you guys and your time. Thank you. Enjoy your Saturday.
guys, thank you for coming out. I know the weather was bad. On your way out, make sure you grab one of these. This is a Final Wishes planner. One of the things that Elliot talked about was having that conversation with your family so you can know and they can know exactly what you want done. This is a simple 2 or 3 page document, and it goes over all of those specific questions. You know, location of my important papers, where they're at. Are they in a lockbox? Where are my tax returns, my retirement accounts? Do I have a checking or a savings account? Take this with you. I ran copies off. Use this. Use this as a guidance tool to talk with your family about exactly what you want done when God calls you the other way. Thank you so much. We'll see you guys tomorrow. Bye-bye.
Thank you, sir. Appreciate that. Thank you. Great questions.